Welcome to the James A. Baker III Institute for Public Policy at Rice University. I am delighted to host this discussion today on an issue of fundamental importance to our country, and that's the issue of tax reform. I am the founding director of the Baker Institute, Edward Djerejian, and I'm here with two Baker Institute fellows scholars, John Diamond, who is our Baker Institute Fellow on Tax and Expenditure Policy, and Professor George Zodrow, who is a professor in the Economics Department and a Baker Institute Rice Scholar. These gentlemen have just produced a very important report that we are publishing this week called Fundamental Tax Reform Then and Now. It is a report that is being distributed to decision makers in Washington and throughout academia. And they have taken a very comprehensive look at the whole issue of what tax reform means, what its implications are for public policy. They state that in recent months we've seen renewed interest throughout our country on fundamental reform of our nation's corporate and personal income tax systems. And they discuss fundamental tax reform, analyzing what happened in 1986, in the passage of the Tax Reform Act of that year, which was the last sweeping overhaul of the income tax system in the United States. They state that in their view, the conditions are right now for a sweeping reform of the tax system, and indeed the case for reform may be stronger in their view than it was in 1986. So they discussed the similarities and differences between the current situation and the environment that led to the Tax Reform Act of 1986. Secondly, they identify some general principles that should guide the process of achieving reform. And finally, they identify the general outlines of what they believe fundamental tax reform of both the individual and corporate income tax systems should be. So this report could not be more timely. So welcome, gentlemen. It's good to have you here. First question to both of you, and I'm going to start off with you, John, is what have the most recent commissions that have been focusing on deficit and debt reduction proposed in the way of tax reform? What are they saying?
Well, there's been a flurry of activity around this issue recently. Most notably, the President's Budget Commission recently put out a report on reforming the tax structure and reducing spending in order to reduce the deficit and eventually the debt. We've also had plans by outside groups, and we have an older plan from President Bush's advisory panel on tax reform. The recent President's Commission proposed sweeping changes to the individual tax system, in which they proposed eliminating almost all tax expenditures. Actually, they kind of provided a sliding scale. So at one extreme, they would reduce all tax expenditures and reduce rates down to very low levels, approximately between 21% for high-income taxpayers and 10% for low-income taxpayers. And then as they added tax expenditures back in, the rates went up in order to maintain revenue neutrality. So the first lesson we see from these reports is that the same lesson we saw in '86, which is a broad-based, low-rate system, seems to be a very sensible approach to tax reform.
So a broad-based, low-rate system is in your view, a principled approach toward tax reform?
I think it's a standard approach among economists that economists in general have advocated as being the most practically efficient reform. It's simple to implement, right, and it doesn't require all the decisions that we see. It may not be the most theoretically efficient in terms of, as economists, we have research papers that say very technical ways of what we should tax, but implementing that in a practical setting would be very difficult. And so just to advocate a broad base, so taxing as much income as possible at low rates, is just a sensible approach that's easy to implement. And I think that's why it has such sticking power.
Easy to implement from an economist's point of view, but politically difficult to decide in our body politic, right?
Exactly. Anytime you start tinkering with the tax system, the politics become difficult very quickly.
Absolutely. Well, George and John, both of you, the Tax Reform Act of 1986 was the last sweeping reform we've had, right?
Yes.
And so John alluded to this, but are the conditions similar in any way to the conditions that existed prior to 1986? And if not, how are they different?
Yeah, well, I think in some ways there are some similarities, and at the same time there are some important differences. The similarities primarily lie in the desperate need for reform. I think there's a widespread recognition that the tax system as currently constructed causes many problems. It's inefficient, it distorts decision-making of both consumers and firms. It is unnecessarily complicated. It effectively implements an industrial policy by favoring certain industries over others. So there are many economic reasons for having tax reform. At the same time, although the current environment is highly partisan, I think it's important to remember that in 1986 the environment was quite partisan as well. Right. We had Congress was split between the two parties, and both parties were trying to position themselves to capture both houses in the next election. A lot of political pundits argued that it was simply impossible to accomplish anything as sweeping as the Tax Reform Act of 1986. And in fact, for a long time it appeared that that was true. The path to reform was really quite tortuous, and several times it looked like the whole effort was doomed. But ultimately, both because of strong leadership from the White House and due to a well-constructed reform plan that had broad appeal to both Democrats and Republicans, to Democrats by virtue of the fact that a lot of preferences that tend to favor high-income individuals were being eliminated, to both Republicans and Democrats just by virtue of the fact that tax rates would be lowered, improving incentives for saving, investing, labor supply, and equalizing the treatment of investment across many types of industries. All of these factors together made for a very strong package, and with political leadership, if you remember, the Tax Reform Act of 1986 actually passed by a vote of 97-3.
Amazing.
In the Senate,
yes.
At that time. So some of the elements and the need for reform, I think, are there. There are a couple of things which may make it a little more difficult. One problem is that the current revenue estimates that we have basically take into account certain temporary provisions and assume that for example, that the alternative minimum tax is not patched, is not fixed. The alternative minimum tax is a second tax on top of the current personal income tax, and has the effect of backing up the system. But as a result of recent changes, including some changes in 1986, the alternative minimum tax, if not patched, that is temporarily fixed, would hurt many middle-income families and raise a lot of revenue from them. The current projections for revenue assume that those revenues are in fact raised, and also that the Bush tax cuts expire, which is a problematic assumption as well. So we have to make up revenues from both of those sources ultimately. But if we were to do that in the context of tax reform, I think it would make things much more difficult. And in fact, one problem that the tax panel in 2005 faced was that they did try to make up revenue from the alternative minimum tax, and as a result, the rate reduction they were able to achieve was quite limited. The second thing which is different is that back in '86, one of the features of tax reform was a fairly sizable shift in tax burden from individuals to corporations. And the implication of that was that the bill, although it was revenue neutral in total, was able to, at the same time, be sold as an 8% tax cut for all individuals, because that revenue was made up with higher taxes on the business side. I think in the current environment—
Now, is that the corporate tax per se?
The corporate tax,
right.
Exactly. I think in the current environment with the corporate tax rate in the U.S. Second highest in the world, it seems unlikely that that any reform effort would use the same trick, as it were. That is, try to raise revenue to provide individual income tax cuts by effectively rating corporations for more revenue.
Right. And lowering the corporate tax rate in America has become quite a point of discussion now, both Democrats and Republicans, in terms of America's competitiveness in the world, right?
Absolutely, absolutely. There's a sense, there's sort of two fundamental problems. One is just due to the high rate and the effect on the effective tax rates that business firms face. Now, because of a variety of provisions, the actual effective tax rate is not as high as the statutory rate, but nevertheless, most estimates suggest that, relatively speaking, our tax rates, corporate tax rates in the U.S., both statutory and effective, are relatively high. But the second problem is different in nature, and that is that multinational firms have a considerable capability to move income just using accounting mechanisms across borders. Right. And so that can mean either shifting income to a low tax country or to a tax haven, a very low tax country. But as long as the statutory rate in the U.S. is relatively high, we're creating a serious incentive for income shifting abroad. And so one reason for a broad-based low-rate reform is to reduce incentives for such income shifting.
Okay, well, George and John, you're in front of a congressional panel, or you're in front of a executive branch commission looking into tax reform. What criteria would you both suggest to guide and evaluate a tax reform package?
I think George pointed out an important point. Most tax reforms are set up under one criteria, which is revenue neutrality. Right. So the politicians just state beforehand that we're not trying to raise additional revenues with this reform. We're just going to reform the system, and we're going to leave the question of how much revenue we should be raising to a later discussion. So effectively you're saying, let's just focus on creating an effective and efficient tax structure, and let's address the question of how much revenue we need to raise at a later time. And George's point was that currently we have the AMT and we have the Bush tax cuts, which are all temporary, so they're all set to expire.
When?
So the Bush tax cuts will expire at the December 31st, 2012. And the AMT, I guess that's also in December. It may be a 1 year or 2 year extension, but I guess it is a 2 year extension to 2012. So everything is going to expire, basically right after the next presidential election, which will make it a hot political topic. So it's really one that reforming, because fundamental tax reform is so difficult, we shouldn't impose more political difficulty on the system of structuring the tax, of creating an efficient structure of the tax system. And we should just focus on that point alone. And then we can have this argument about how much taxes we should be raising and how much spending we should be cutting.
That's really an essential equation, isn't it?
Yes.
One should not talk about tax reform without talking about expenditure policy. And often that balance is not there, not only in our discourse, but in actual political acts. Am I correct in that?
But you're correct.
Yes.
And a lot of that is due to how bills move through Congress. You know, tax bills move through the Ways and Means Committee, and spending bills move through House Budget Committee. but just so we split that decision. But I think it's important when we start on a tax reform that we just say it's going to be a revenue neutral bill. But the problems we have now is revenue neutrality is not even clear anymore, because is it revenues that we're going to raise before 2012, or is it revenues that we're going to raise after 2012? So after 2012, the Bush tax cuts and the AMT have both expired. And so the tax system will be raising more and more revenue as a percent of GDP. So our approach is, let's go with a revenue neutrality assumption. And at the same time, let's assume that the AMT is permanently extended and the Bush tax cuts are permanently extended. And then we can set up a system that is structurally efficient to raise that amount of revenue.
And that assumption's in your paper.
And this assumption is in our paper.
Right.
It'll make the process politically manageable. So we need to focus just on the structure, leaving this argument, this debate about how much revenue we need to raise. And at the same time, the discussion of cutting spending, how much spending we need to cut in order to balance the budget. That should be a separate discussion. I think that's the first criteria we should focus on.
George, what about, you talk in the report about distributional neutrality. Could you explain that?
Yes, that was another criterion that was adopted in the passage of the 1986 Tax Reform Act. And basically the underlying philosophy is the same, which is that tax reform, structural tax reform, is way difficult enough by itself.
Right.
Without it trying to raise a lot of additional revenues or redistribute income through the tax system. And so one of the constraints placed on the tax reform process in 1986, and also with the 2005 report of the President's panel on tax reform, was to assume revenue neutrality. I mean, distributional neutrality as well. Right. And so one, of course, has to define what one means by distributional neutrality and whether or not it includes the Bush tax cuts. So our view is that it would be simplest to assume that those are permanently extended, and then in future discussions, which we recognize have to occur, we just argue that they should be treated separately from tax reform. So we will have to decide as a nation both how we want to address our deficit problems and what the burden across income classes of addressing that problem should be.
That's really a hot political issue.
Oh, absolutely.
This is really one of the hottest political issues because, of course, liberals on the one side and conservatives on the other, the issue of using the tax system in a very determined way to redistribute wealth and income in the United States is one of the key issues that have surrounded tax reform from its inception, right?
Absolutely,
yeah.
Absolutely.
And that's an issue that we often think about primarily, is this distinction between high income and low income, or rich and poor.
Right.
An additional source of equity is, does the tax system treat equals equally? So does the tax system treat people that are fundamentally the same equally? And I think everybody would say that.
What's your answer to that?
If there are two people, well, I mean, we look at it, and I think that a criteria for the tax system should be that equals are treated equally. Obviously, that doesn't always happen.
You both are strong advocates of simplicity. I think every American would agree we need a more simplified tax code. It certainly makes CPAs very wealthy in the country. But how do you get at the issue of simplicity in your recommendations in your report?
Well, it is a tough issue. Simplicity is something which is always, when the process of tax reform starts, simplicity is always listed as one of the main criteria. But as the process evolves, it seems that simplicity is always pushed toward the end of the line. Right. Our view is actually that the President's Tax Reform Panel in 2005 was really quite zealous in maintaining its commitment to the simplicity argument or the simplicity rationale for tax reform. And so we endorse most of their recommendations, in particular to try to consolidate and simplify the vast system of credits and deductions that we have, to try to simplify business accounting, both for large firms and for small firms. That would include changing the system of depreciation deductions that we use along the lines that they recommended, to consolidate the savings plans. We have many different incentives for saving under the current system, and they proposed a system in which those savings plans would be collapsed into 3 different programs, and then finally, eventually eliminating the alternative minimum tax as a major source of complexity for
it is
many
a major
individuals.
source of complexity, AMT. That is one of the. Well, how does tax reform impact on economic efficiency and neutrality, as you mentioned in your report?
Well, that's a fundamental criteria, mainly because I don't think you want the government picking the winners and the losers. Mm-hmm. And that's the basic idea behind economic neutrality. Is
some people do. Some people would like the government.
Some people would like the government.
I mean, that gets into the political domain. Right.
Yeah. But I think in general, most people don't want the government to be the entity that decides who wins and who loses. I mean, in my discussions with people, it's usually fairly common for people to say that the market will determine who are the winners and the losers based on who competes the best. For the government to impose a tax structure that favors one type of business over another, and therefore encourages investment in one type of business over another,
or one economic sector over
or
the
one
other,
economic sector over another, corporate
right.
versus non-corporate,
right.
housing versus non-housing, right. Then that creates, destructive economic incentives. So our scarce resources will be used in a way that they're not most highly valued, and that needs to be a fundamental criteria of the system, is that it imposes the least amount of distortions on both business decisions and individual consumption decisions. And so we discussed that in our report of just basically as another justification for the broad-based low-rate approach, and implementing a broad-based approach solves a lot of problems,
yes.
and this is another one, and so we again would.
And that's a common theme in your report.
It is
the broad-based approach. I mean that. Okay.
It's a very common theme, both in dealing with business taxes and in individual taxes. So I think it's just best to say that we argue for that approach in terms of economic efficiency. Mm-hmm. So that the market can determine the winners and losers, right. And not the government.
And obviously, George, this has an impact on foreign investment and how we create a favorable environment for foreign investment, especially since the United States is competing in an increasingly globalized economy, which is a major issue, of course, both politically and economically. Can we keep pace? We have the emerging powers. We have China. We have the Brazils, India. How do we maintain our cutting edge and competitiveness in a globalized economy? So,
no, I think that any tax reform is going to have to address, perhaps to a greater extent than in the really long distant past,
right.
The way that the tax system treats foreign investment, and there's really two dimensions to this issue. We have to worry about how the tax system treats U.S. investment abroad, investment in other countries by our multinationals, mm-hmm. But also investment by other countries in the U.S. is
right.
very important as well in today's globalized economy. And so we have to have a system that both equitably and efficiently taxes foreign income. And in that regard, there's a couple of approaches, well, both of which have their advantages and their disadvantages. So one approach recommended in the 2005 report was a territorial or an exemption approach, under which U.S. firms would not be taxed at all on their earnings earned abroad. Which has some important advantages in terms of competitiveness, but at the same time creates some opportunities for tax avoidance that are troublesome, and also some cost allocation issues that are problematical as well. So another approach recommended in some quarters is to sort of go the other direction and move toward a system that would eliminate deferral, that is, tax all foreign income in the U.S. currently, but at a much lower rate. So this would have to be done in conjunction with the broad-based rate-lowering reform that we've been talking about, so that the actual rate applied to repatriated income would be quite low. The other underlying feature which has to be taken into account when thinking about international issues is the income shifting issue I mentioned before.
Right.
That is, we simply have to have to lower our tax rate so the incentives for income shifting are not as great as they are currently.
Today. Well, I think everyone agrees, if I can make a broad generalization, that the individual income tax system is inefficient, it's unfair, it's overly complex, as we've discussed. So how do both of you propose to reform the individual tax system? John?
Well, we started the discussion by kind of rehashing what was going on in 1986.
Right.
And we're at the very similar point now with the tax system and its inefficiency, its complexity, and its unfairness. In '86, what they did was they broadened the base by eliminating multiple exclusions. They excluded, they eliminated the exclusion for long-term gains, for the investment tax credit, deductions for two earners families, income averaging, the deduction for state and local sales taxes, and different consumer interest deductions. As well, they eliminated deductions for depreciation and passive activity losses on the business side, and how businesses were allowed to deduct entertainment and business meal expenses. However, they didn't touch several kind of third rail type deductions.
Yeah, explain some of those, or just list some of those.
Although internally they discussed reducing or eliminating deductions such as the home mortgage interest deduction or the state and local income and property tax deduction.
Right.
At the end of the day, I think they were just too politically toxic to touch. Unfortunately, I don't think we have that. I don't think we have that luxury anymore. I think those,
even though they remain third rail issues and they're politically toxic to touch, you feel that we don't have the luxury of putting them aside,
of walling them off,
and walling them off again.
We're not going to touch
so
these deductions. So here comes
the politics of tax reform.
Exactly.
And I know that you've consulted with our honorary chair, James A. Baker III, who was Secretary of Treasury and one of the authors of the 1986 tax reform policy. But the politics of tax reform are perhaps as daunting as the economics of tax reform.
I think that's true. So when you go to this, you kind of go back to the '86 approach, broad-based, low rates.
Right.
You want. So how do we get there? Well, I think now we have to bring in some more politically toxic ideas. So some things that are going to be really politically difficult, and they're going to have to really roll up their sleeves.
See, you're an outstanding economist, but if you were a politician, you might not be as assertively saying we got to bring in these toxic issues.
I would definitely be a little more restrained.
You might have a different point of view.
Absolutely.
But you're really touching on something that's critical. Are these major factors of the home mortgage rate, for example, charitable deductions? I mean, is that part of the equation, which is, in a way, one of the great inducements for the great philanthropy of America, the 501c3 organizations you can get income tax deductions from. Are these third rail issues on the table? Are they on the table? Do you think they've politically can be put on the table?
I think they have to be on the table. I don't think it's a question of if it's politically possible anymore. I think, and I do think they've been pushed onto the table in a couple of the reports. The president's, the 2005 Presidential Advisory Board put a couple of these issues on the table.
They did.
Absolutely.
Yeah.
And the recent Budget Commission, President's Budget Commission, I mean, one of their proposals was just to get rid of everything, all tax expenditures, including the mortgage interest deduction and state and local income taxes and the property tax deduction. So in a sense, in a non-political sense, they've been put on the table through these reports. And I think politicians are going to have to start to deal with them. Now, it doesn't mean you have to eliminate them. Maybe just restructuring would be the best idea. So the mortgage interest tax.
Is that what you recommend in your report, restructuring?
We do. We recommend which ones we would restructure and how, and which ones we would just eliminate. And the mortgage interest deduction is an interesting example because it has a purpose of encouraging home ownership.
Right.
But yet when you look at it, the nuts and bolts of it, does it really encourage home ownership? I mean,
fundamental question.
Most middle and low income people don't itemize their taxes. And so they don't benefit from the mortgage interest deduction.
Right.
Most high income people are going to own a house anyways. And the only thing the deduction is doing is encouraging them to buy bigger houses. So reforming it in a way that it achieves its objective of increasing home ownership in the U.S. While limiting the amount of revenues that it cuts off would be a very sensible approach, and we discuss a way in the paper of doing that. Similarly with the charitable deduction, we don't come out in favor of eliminating it. We would just like to see it, we actually propose that you just implement a floor so that if you give a certain amount, you still get a deduction. But since the goal is to get people to be charitable.
Which is a very important goal.
Let's put a base amount on the amount of charitability that we require.
Interesting concept.
And then we think that you should, on the state and local income tax deduction, economists generally believe that state and local income taxes are just a payment for state and local services that people consume. So it's basically we're giving a deduction, we're giving a subsidy to consumption at the state level, and that's hard to justify from a federal standpoint. So we believe an efficient reform would eliminate that deduction. Now there are some things that states do that have large national spillovers. And if you eliminate the deduction, you would need to step in on the federal level and subsidize that activity.
Like what, for example? I mean, where the spillover is at the federal level?
Well, I mean, to give an example that a very politically hot example, reform. So let's take border enforcement. Some types of border enforcement may be viewed as having national security, as well as just positive effects for all states, not just the states on that border. And so doing something about that, if there's some federal expenditures, direct expenditures,
you have a justification
to enforce the borders, then you have that justification to do that. There is an economic justification as well as a political justification to do that. So that lays out some of the most toxic deductions that we've addressed in here. We talk about a few more, and George discussed these, and basically we've just taken what the President's 2005 Tax Advisory Panel discussed, which is consolidating all the low-income deductions and credits into one simple credit that achieves the goal of equitable transfers to low-income people. There's a variety of savings incentives, 401ks, 403bs. I mean, the list goes on and
Quite
on.
complex.
It is very complex. And again, the advisory panel very nicely put all those together into just a couple of options, and then also expanded them so that we could reduce the distortions that are currently imposed in the income tax between current and future consumption in a simple and efficient way. So again, we kind of support their approach there to individual side tax reform.
Yeah, and I think just one important thing I think in this whole process, especially on the individual side, is to sort of not give away the store early on in the process. Because one of the things.
What do you mean by that?
Well, by that, what happened in the case of the 1986 Act, as John mentioned, one thing which ultimately was not touched was the home mortgage interest deduction. And basically what happened was that early on in the process, the president was addressing the National Association of Home Builders and was asked the question, if anything might be done about the mortgage interest deduction, and his response was exactly the correct response, which was, this is fundamental tax reform, everything is on the table. And so we were looking at all of our options. And what would have been perfect would have been had he stopped there. But approximately one day later, there was a follow-up statement which basically said that the home mortgage interest deduction was going to be not touched. And that turned out to be really an important constraint on the whole process.
There's the politics of tax reform right there.
Absolutely. But if you agree very early on to exempt what accounts for half of the capital stock, then it's going to be very difficult to affect a truly fundamental tax reform.
What you're both intimating rather clearly is that this is a moment, if we're going to have serious tax reform, as you put in your report, fundamental tax reform, some very difficult political decisions have to be made by leaders on all sides.
Absolutely.
There's no question about that. The political will, political courage has to be there for us to get from point A to point B. We mentioned the U.S. corporate income tax rate. You said it's the second highest in the world. And in his recent State of the Union address, President Obama supported lowering the corporate tax rate. That made the business community, I think, happy. And broadening the base so that reform is revenue neutral, along the lines that you advocate, broadening the base, revenue neutrality. So what do you think about this kind of reform?
No, I think that's exactly the way that we should proceed. I mean, basically what we need to do is, again, adopt an approach similar to what was done in '86, make a concerted effort to try to eliminate the extent to which the tax system functions as an implicit industrial policy in the United States, and try to the extent possible, eliminate special preferences and deductions that benefit certain firms over others. Again, here we're not starting over here. These proposals have been around for a long time. There's an excellent report by the U.S. Treasury in 2007 which details what a lot of these tax preferences are and estimates, or suggests some paths for reform. The big items basically are the special deduction for U.S. manufacturing activities to implement and accelerated depreciation deductions. Another important one is the research and experimentation credit, although that's a much tougher one because there are some external benefits to research and development. And so it's not, in the case where we have important external benefits, then some government role, some federal role in encouraging that is appropriate. But beyond such very carefully and well-defined areas, I think the notion of broadening the base and reducing the rate is very compelling. There are some arguments to the contrary, and one argument that we heard a lot in 1986 and here now as well is that we really shouldn't be worrying so much about lowering the rate lowering the corporate tax rate and instead create investment incentives of various kinds. So things like investment tax credits, investment tax credits and accelerated depreciation allowances and such, with the argument being that those apply only to new investment, whereas a rate reduction applies to new and old investment and therefore is relatively costly. And there's some truth to that argument. There's no question that it has some validity, but I think on balance, the argument for lowering the rate is compelling for the reasons we've discussed, but also because, as I've mentioned, we do worry a lot about income shifting, and if the rate stays high, the incentives for income shifting remain.
What do you mean by income shifting?
Income shifting is the process by which multinationals shift their income abroad through using mechanisms like transfer pricing, loan allocation, many ways in which, and there's a ton of empirical evidence supporting the notion that multinationals are quite effective in shifting income abroad to low-rate regimes. So we want to reduce incentives for that. And the other big advantage of a relatively low tax rate is that a lot of these investments that are made by foreign multinationals as well as U.S. multinationals are investments that earn what economists refer to as firm-specific rents or above normal rates of return. And for such very successful investments, if you're trying to attract those, then investment incentives like the investment tax credit really don't matter too much. They want the low rate. They want the high profits taxed at a relatively low rate. And to the extent that these are specific to the firm and can be located anywhere, then there's a real important reason for the U.S. to try to attract those investments here.
Is there any other way we might reform, George, the corporate tax to make it more favorable to investment?
I think there is. I think such a reform would be certainly more sweeping in nature and therefore presumably more difficult from a political perspective, but nevertheless quite well worth considering, I believe. The Tax Reform Act of 1986 that we've talked about quite a bit today did many good things, but what it didn't do was lower the overall tax burden on corporate income, and at the same time it did nothing about eliminating the tax bias that the system has at the business level for debt finance. That arises because interest is deductible, whereas dividends paid to shareholders are not. And so the tax system is heavily biased towards debt-financed investment. A lot of reforms have attempted to address these issues as well. And the one that we favor in the report is a plan that has been recommended recently by the Mirrlees Commission, which is a commission in the United Kingdom headed by Nobel Prize winning economist James Mirrlees. And what he recommends is that the corporate income tax be adjusted to include what is referred to as an allowance for corporate equity. What that would be is an additional deduction comparable to a deduction for interest expense, which would equal the value of equity capital in a firm times some interest rate. And that would have the effect of putting both debt and equity on an equal footing, and thereby reducing or in some cases eliminating the tax favoritism or tax bias that we currently face favoring debt-financed investment. It also has the effect of lowering the effective tax rate on investment to zero at the margin at the business level under this form of corporate income tax. And there's been some experimentation, not a lot, but some experimentation with this approach in several countries around the world. So it is a consumption-based approach to taxation at the business level, but it's one that doesn't include expensing. Normally, consumption-based plans call for expensing, immediate write-off of all investment, but that's a very drastic change.
And this does not incorporate that?
This does not. It has an additional deduction which has the same effect economically, but doesn't represent such a drastic change from the existing system. It also has some other advantages which are quite important, one of which being that there's an internal adjustment for accurate income measurement. So even if you get your depreciation deductions incorrect, which inevitably you do, there's an offsetting change which eliminates the effect of that due to this additional deduction for equity. So this is called the allowance allowance for corporate equity, or ACE, ACE plan. And it's something that we think at least deserves serious consideration in the United States. And even if it were not adopted in full, one possibility would be to allow partial deductions for the ACE. That is, allow perhaps a 10 or 20 or 50% deduction instead of the full deduction, which would have the effect of at least reducing the tax bias favoring debt investment. It might even be used as a temporary investment incentive. Right now, we very often have investment incentives, immediate expensing, partial expensing, used as a counter-cyclical factor.
Right.
Well, this would be a much better, I think, counter-cyclical tool because it would have the effect of making investment more attractive, but it would do so in a way that would not exacerbate or really keep constant that tax bias toward debt, because it would apply only to equity financed investment. So a partial ACE or a cyclical ACE would allow an extra deduction for investment, equity financed investment, depending on economic conditions, while keeping the treatment of debt financed investment the same. And I think either as a counter-cyclical tool or as a permanent feature of the tax system would be quite attractive. An obvious downside is the cost revenue. We are introducing an additional deduction, and we propose that primarily in the context of a distributionally neutral system, that any revenues lost here be made up with higher tax rates on dividends and capital gains at the individual level. Now that moves it away from a consumption-based tax, and there certainly are arguments against doing so, but it does at least concentrate the taxation of capital income at the individual level, which means we keep the business level tax quite attractive, both for domestic investment, but especially for foreign investment. So that, in our view, is a proposal which is perhaps a little more radical than just the standard base broadening rate reducing reform, but one which we think deserves serious consideration as the process of fundamental tax reform unfolds.
And you recommend this in your report?
We did.
That'd be sir.
Absolutely.
Let me ask you a last question, which is really the incredible challenge our country faces in terms of the growing national debt and deficit, which economic historians like Neil Ferguson have made the analysis and the analogy that no country, no preeminent power in history has been able to escape a fundamental economic challenge from within when a country spends much more than it brings in. The imbalance between revenue and expenditure and indebtedness. And according to Neil Ferguson, he does an analysis of the pre-revolutionary France, the Austro-Hungarian Empire, the Ottoman Empire, the British Empire, and when the debt comes to a certain percentile of GDP, it can very well be a signal of serious decline. A country can no longer simply project its influence and power abroad, be it political, economic, and military, as it did before when its economic house was more in order. We've seen that historically. And while we as Americans really attach a great importance to American exceptionalism, it's my view, at least, that America is not exempt or exceptional from these basic economic factors. If a decade or two ahead of us, we fall into this same historic trap. I'm not a declinist in terms of America, but there are emerging powers that are coming up, and we have a lot more competition, and we're not going to be as preeminent as we have been. But America still has many, many assets and resources and innovation that we can keep there. But if we don't get our economic house in order, this is for our children and our grandchildren a real compelling challenge. And it doesn't look very rosy. How does what you're talking about in this report on fundamental tax reform impact or doesn't impact on the serious debt and deficit issue?
Well, I think the primary impact is that the underlying problems with the debt and the deficit imply that at some point in the really near future, and I think there does appear to be increasing awareness of this fact. Over just the last year or so, it seems to me that there's been a great deal of attention paid to the deficit and debt problems that we face as a nation. And we have to address those. We have to address those systematically. A lot of that is going to be in terms of programmatic reforms of entitlement programs. So we have to, the relatively easy one to fix is social.
Third rail.
Is Social Security. I mean, Social Security is as important a program as there is.
Medicare?
Medicare is the next one. Medicare and Medicaid are much more difficult. Even though I think people tend to think of Social Security as the source of many of our long-term problems, although it is to some extent, it is not nearly as difficult to fix as the potential shortfalls in Medicare and in Medicaid. Exactly. So all of those programs have to be addressed directly. But I think it would be naive to assume that we can fix all these problems without using the tax system to raise more revenue.
Right.
And if that's the case, and which we believe that it is, it really becomes essentially important that the tax system function efficiently. Because if we are increasing our reliance on the tax system, and the tax system is a very poor instrument, it's highly inefficient, it's highly complex, it's inequitable, then the problems, the difficulties associated with trying to raise some additional revenues become greatly increased. And so it's important when thinking about addressing our long-term fiscal problems to understand that part of the solution will be increased revenues, and if we are going to use the tax system to generate more revenues, it's important that we fix it before we start riding it more heavily.
Very good. You agree, John?
I do agree. I think the tax, we will need to raise more revenues.
Right.
And we need to raise those revenues while keeping rates as low as possible. And that's why a lot of what we have proposed and what others have proposed is that you quit spending through the tax system. So you quit giving away deductions and credits in order to please voters, which is why it's such a politically difficult issue.
Right.
At the same time, I think that spending does need to be the bigger factor. Unfortunately, the problem doesn't stop at the $75 trillion or $100 trillion problem that some have estimated on the federal level. It runs all the way down our systems of governments, all the way to states, cities, and even municipalities.
Exactly.
Houston is in horrible financial shape. And some people question, is Houston capable of staying solvent, or will it have to file bankruptcy? Because on the state and local level, we've promised pension benefits to state employees, which are just unaffordable by any measure. And
they're like promissory notes.
Promissory notes that we have to pay that will be a huge burden on future taxpayers.
As many municipalities in America.
Yeah. And on that level, we just have to cut benefits. We need to cut benefits as much as possible to solve the problem. And we need to rely on raising taxes as little as possible, in my view.
Right. Well, we've seen that problem in Europe in a major way. Well, gentlemen, thank you very much. You've produced a very timely, a very relevant report that we hope our decision makers will take a hard look at. And really, in many ways, as our discussion has evolved, we're dealing with some of the most fundamental challenges our country faces, economically and fiscally in the future. Well, thank you very much for your work and for your participation.
Thank you.